Good morning. It is Tuesday, March 24th, 2026. This is your Deep Dive Daily Briefing. I am your anchor, Cora, delivering a comprehensive analysis of the pivotal events that have defined the last 24 hours. We begin our broadcast on the world stage, where the strategic landscape of the Middle East has seen a dramatic and unexpected shift in tone. Following 4 weeks of high-intensity conflict, United States President Donald Trump announced late yesterday, 9:30 p.m. Eastern Daylight Time, that he is postponing any military strikes against Iranian power plants and energy infrastructure for 5 days. This decision followed what the president described on Truth Social as very good and productive conversations regarding a potential resolution to hostilities. However, the situation remains precarious as the Iranian Revolutionary Guard issued a simultaneous threat to target Israeli power plants and U.S.-based energy supplies if the reprieve ends without a permanent deal. While the death of the previous Iranian supreme leader and the subsequent hardline stance of the successor regime have complicated diplomatic efforts, this 5-day window represents the first significant pause in a war that has already resulted in over 2,000 fatalities and massive regional displacement.
Transitioning from the front lines of diplomacy to the broader global economy, the news of a potential de-escalation sent shockwaves through the energy markets. Crude oil prices, which had soared above $114 a barrel earlier in the session, plummeted by over 13% following the White House announcement. Brent crude fell to approximately $96 a barrel, while West Texas Intermediate dropped to $85.28, marking the most significant single-session decline since the start of the conflict on February 28. Despite this immediate relief, the global economic outlook for 2026 remains one of constrained stability. The International Monetary Fund continues to project global GDP growth at 3.3%, but warns that the system is operating with significantly narrower margins of safety. Manufacturers in Europe and Asia are still grappling with a trade-weighted average tariff rate that has risen due to recent protectionist shifts, even as they attempt to capitalize on this momentary cooling of energy-driven inflationary pressure.
In the realm of finance, all eyes are on the aftermath of the Federal Open Market Committee meeting as the market recalibrates its expectations for the remainder of the year. Following the Fed's decision last week to hold interest rates steady in the 3.50% to 3.75% range, investors are now pricing in a 35% probability of a recession by year-end. Jerome Powell's final press conferences as chair have emphasized a wait-and-see mode, acknowledging that while the economy remains resilient, job gains have stalled with a loss of 92,000 positions recorded in February. On Wall Street, the focus is shifting toward the impending leadership transition at the central bank, with Kevin Warsh set to take the helm in May. Financial institutions are currently navigating a landscape defined by sticky inflation and high financing costs, forcing a concentrated rotation toward defensive assets even as the sudden drop in oil prices provides a temporary boost to consumer-facing sectors.
Turning our attention to the technology sector, the focus remains on the rapid build-out of artificial intelligence infrastructure and the official arrival of the agentic era. Following the landmark announcements at GTC 2026, Google Cloud and NVIDIA have confirmed they will be among the first to offer Vera Rubin rack-scale systems in the second half of the year. This hardware is specifically co-engineered to support next-generation reasoning and mixture of experts models. Simultaneously, the industry is witnessing the debut of physical AI applications at the edge, with T-Mobile and Nokia piloting new AI RAN infrastructure to transform wireless networks into distributed computing platforms. These advancements are enabling a new class of multimodal AI agents that can perceive and act in the physical world, even as the global semiconductor market approaches a projected $975 billion valuation for 2026 despite the ongoing geopolitical headwinds affecting global procurement.
Finally, we look at the logistics and supply chain networks that serve as the vital arteries of global commerce, which are now witnessing a structural rewiring of the African coastline. With the Strait of Hormuz remaining effectively shut despite the 5-day strike delay, major carriers like Maersk and Hapag-Lloyd have made the Cape of Good Hope their default route. This rerouting has triggered a 112% surge in bunkering activity along the African coast, as vessels seek to refuel outside the volatile Middle Eastern corridors. Logistics providers warn that the 19-day penalty for westbound transits is no longer a temporary measure but an operational reality that has reduced annual cargo capacity by 10%. As a result, 72% of trade professionals have now prioritized regionalized supply chains and AI-driven inventory positioning to mitigate the $3 billion weekly cost increment associated with this great reroute, signaling a permanent tax on global trade that will likely persist long after a ceasefire is reached. That concludes our global briefing for today. Thank you for joining us. I am Vivian.